explain a question from page number 192 IGCSE O level textbook. Here you can see the 14th question. Preeti is a trader. Her financial year end on 31st March. Her trial balance on 31st March 2004 as follows. See here, capital balance given, capital balances, drawings, trade receivable, almost all items are there, assets, liabilities, capital, everything. See, assets, premises, fixtures and fitting at cost, motor vehicle at cost, and provision for each items as well. See, provision for the fixtures and fittings, provision for depreciation on motor vehicle. So provision for depreciation on fixtures is there, provision for depreciation on fixtures, motor vehicle is there, then provision for doubtful debt. This is old provision, last year's. And revenue given, opening inventory, everything, all the items, almost all the items are here. Then apart from that, we have additional information like closing inventory, commission receivable outstanding, accrued. Okay, accrued commission receivable means accrued income, prepaid insurance, so it's prepaid expenses, rights accrued, again prepaid expenses, wages accrued, it's not prepaid expense, rights accrued is a accrued or outstanding expenses, accrued expenses, wages accrued is accrued, again accrued expenses. Second one, a debt of $150 should be written off as irrecoverable debt, so irrecoverable, and the provision for doubtful debt should be maintained 5% on the remaining trade receivable. So a new further bad debts is to be created. A debt of 150 should be written off as irrecoverable debt, so that should be again further bad debt, and again we have to create a provision for doubtful debt to be maintained 5%. A new provision is to be maintained as well from the remaining trade receivable. And fixtures and fittings are depreciated at 20% using straight line method. So this is straight line method, fixtures and fittings. And motor vehicle are being depreciated at 25% using reducing balance method. Okay, motor vehicle. Prepare income statement and statement of financial position. So here, see the income statement. Here, income statement, we will start with the trading section. So first, identify which all the items will be there in the trading section. So before that, we should know the equations for the trading section. Gross profit calculation. Gross profit is equal to revenue minus cost of the sales. So revenue minus cost of the sales simply means revenue is sales minus sales return. Okay, sales minus sales return. Then cost of the sales means cost of the sales is equal to opening inventory plus net purchases minus closing inventory. Okay, so opening inventory plus net purchases minus closing inventory. So we know opening inventory is already there in the question. In the trial balance, you can see here opening inventory will be here. Inventory on 1st April, this is called as opening inventory. Okay, opening inventory, and closing inventory will be here. In the question itself, you can see the as additional information. Inventory valued at on 31st March, it is closing. Okay, this is closing inventory. So right, closing inventory. Yeah, so we'll go to the equation again. Opening inventory also we have, closing inventory also we have. Net purchases is equal to purchase minus purchase return plus carriage inwards minus goods for own use. Goods for own use. So carriage inward is a direct expenses which is related to the purchases. Okay, purchase minus purchase return plus carriage inward expense minus goods for withdrawn. This is drawing for personal use. Okay, drawing of goods, not cash. This will be available in your additional information. So drawing of goods for personal use. This is known as goods for own use. Okay, so don't take drawing as a cash drawing. You can see here drawings 54,000. This is cash drawing. Okay, this is cash drawings. This will not be deducted from the purchases because it is not related to the purchase. But you can see here additional information. If there is any item which is related to the goods drawing, so then you should deduct it. If item is not there, you don't need to deduct it. Okay, so we'll start the problem. So our main equation is revenue minus cost of the sales. So what is revenue here? Revenue is equal to sales minus sales return. So check whether sales return is there or not. Yes, return is there. See here, sales return is there. And how much is revenue? Revenue is 644,000. So you can take here 644,000 minus sales minus, how much is the sales return here? 1,050. 1,050. That will be your final. Either you can do here or here. Okay, the working note you can do there inside or in the column. 642,950, isn't it? So that is revenue. Okay, so that is the main equation, revenue. Next, less cost of sales. Cost of sales calculation. So what is cost of the sales? Purchases. So we have purchases. See, the equation we can do in first column. Okay, this column you can use it for the calculation. So we'll start with the opening inventory, then net purchases. So this is the equation, opening inventory. See here, opening inventory, you can see here 36,000. Okay, 36,000 opening inventory. Sorry, that is the main equation from this cost of the sales calculation. So 36,000 you can take in the second column. Then net purchases, calculation of net purchases. Okay, so net purchases means net purchases, you can write here purchases. Okay, purchases minus purchase return. So how much is purchases here? Check the trial balance. Purchases is 528,850. Okay, then purchase return also you need to check. Purchase return, if there is any purchase return, you have to deduct that as well, since there is no purchase return, right? So you can directly take purchases here, and carriage inwards and goods for own use also should be considered. So carriage inward is the right 750, that also should be deducted. Okay, so purchase minus purchase return. So here only purchases are there, no purchase return. So plus carriage inwards, so carriage inwards should be added. So I'm taking purchases 528,850, then plus carriage inwards 750. Okay, goods for own use is not there. If it is there, then it should be deducted here. Okay, so in this question, goods for own use is not available or not given. So that final figure will be 529,600. Okay, then opening inventory, this is net purchases minus closing inventory. See, closing inventory which will be available in your additional information, it's 41,050. So that should be deducted, 41,050. Then you will see opening inventory the main equation of the cost of the sales calculation I took in the second column. Okay, if there is any adjustments or any calculation, that you can use first column. So opening inventory plus net purchases minus closing inventory, so you will get 524,550. Okay, so this is the cost of the sales. Now apply and calculate gross profit. So gross profit is equal to revenue minus cost of the sales. Okay, so revenue minus cost of the sales means 642,950 minus 524,550. So you'll get 118,400 is your closing gross profit. So this is the final output of trading section. So you will get gross profit here. Since till this calculation we don't have any additional information like adjustments, so here from here onwards we will have additional information like commission receivable. Commission receivable is a revenue, insurance is an expense, rate is an expense, wages is an expense. Apart from that, we have bad debts calculation as well as the depreciation calculation, everything. Okay, so I'm going to the next part. So we got gross profit now. So all these are the calculations. Now what is net profit? Net profit is equal to gross profit plus other income. If there is any other income, should be added. Other income minus other expenses. Other expenses. Okay. So gross profit we already got. Now we will add other income. So identify what are the income which is available in your question. Capital will be SOP item. Drawing is SOP. Trade receivable SOP. Trade payable SOP. Bank is SOP. Premises is SOP. Fixtures SOP. Motor vehicle is also SOP item. Provision is a SOP item. Provision for doubtful debts is a SOP item. Revenue we took in the trading section. Inventory also trading section. Purchases trading. This is also trading. Carriage inward is trading section. Now commission receivable is P&L account section. Rates is P&L account section. Wages P&L account. Administration expense also P&L account. So commission, we have commission receivable. This is income. Income always will be in the credit side. So if you want to find out the income, you can see the credit side of the income state, the trial balance. Okay. So commission receivable 1030. We have adjustment also. Commission receivable outstanding 110. That is accrued income. So you can take this note. If there is accrued expenses is and accrued income. Accrued expense is a current liability. Accrued income is a current asset. Then prepaid expenses. Prepaid expenses is a current asset. Prepaid income is a current liability. Okay, so all the accrued will be added in the income statement. All the prepaid will be deducted in the income statement. Okay, this is income statement. This is SOP. We will take it as current liability, current assets, etc. Okay, so here the accrued income is outstanding means commission receivable is outstanding means 110, right? It's outstanding, it's accrued income. So as we know, all the accrued will be added. Okay, if it is expenses or income, both will be added. Accrued income will be added in the SOP, prepaid will be deducted. So I'm going to the next part. So add other income. We have commission receivable here. So first of all, we need to find out how much is commission receivable. So commission receivable, we already have commission receivable 1030 in our trial balance. With that, we will add this 110 because it is accrued, right? Accrued only we have commission receivable as revenue. So you can take in the outer column 1140 total. So accrued will be added, prepaid will be deducted. Always remember that if it is revenue or expenses, both will be added. Okay. Then next part is less other expenses. So other expenses, we have rates, right? Here you can see what are the items we have. Rates. So commission receivable we took it. No, rates and insurance is 10,400. So what commission received, and this is also done. Rates accrued. So it's accrued expenses. Again, accrued will be added. Okay, accrued expenses are added. Prepaid is deducted. Okay, right. So rates accrued 260. So we will add the rates with 260 with the expenses. Okay, so I'm taking rates here as per the trial balance. Rates are rates and insurance is given together. Okay, rates and insurance. So rates and insurance total is 10,400, isn't it? So with this, what we'll do, we will add the accrued rates. Okay, accrued rates will be added 260, but insurance is also along with this. We don't know the exact amount of insurance, so we have to consider the insurance also in this. Insurance prepaid is 180, so this 180 should be deducted from this because it's all together, it's given. So that's why, otherwise we can take it as separate item. Okay, if it is given separate ways. So 10,400 plus 260 minus 180 will be 10,480. Okay, so I'm taking that here, 10,480 in the first or second column I'm taking. Okay, 10,480. The next one is wages. Wages also accrued is there. Okay, wages amount was 39,400. Okay, and accrued wages is there, right? See here, rates taken, insurance also taken, wages accrued is 1,600. So the accrued expenses is added. So I'm adding 39,400 plus 1,600 accrued amount. Okay, so that will be 41,000. So I'm taking here all the expenses together. Wages, there is no adjustment for administrative expenses. So administration expenses without adjustment, I can take here as 5,335 as per the trial balance. 5,000 wages done, rates done, administration expenses 5,335, isn't it? Yes. Now, apart from this, we have irrecoverable debt calculations. So this is most important here. As per the trial balance, there is no bad debts given, but last year's old provision is given here. Provision for doubtful debts. This is old provision. Okay, which is that will be available in, that's a liability. That's why it's credit side. So 2,360 old provision is there. Apart from that, we have a new doubtful debt or irrecoverable debt. Okay, we have doubtful debt as well as irrecoverable debt. So debt of 150 should be written off irrecoverable debt account. So the income statement account is debited, irrecoverable account is credited. That journal entry will be applicable here. So it will be in the debit side of the income statement, means expenses. Okay, that's why this is the transferring entry. So we have to write it as, it's a new bad debt. Okay, it should be written off irrecoverable debt. Irrecoverable debt 150, you can write it here. Okay, that is the new bad debt. Further bad debt we can say. Apart from that, we have to create provision for doubtful debt. See here, provision for doubtful debt. A provision for doubtful debt should be maintained 5% on remaining trade receivables. 5% on remaining trade receivable. Okay, so we have to consider the trade receivable here, 49,000. See here, 49,270. So already we know that additional information, it's given that how much, 150, right? 150 is written as irrecoverable. It means that is not it will not be it will not recover from the trade receivable. So that amount is not deducted from this. Okay, because that is additional information. So 49,270 minus that 150 will be your actual trade receivable. Okay, so it will be 49,120. This is your trade receivable actual balance. Okay, because if it is given in your additional information, that amount is not deducted from this. Okay, that is after preparation of trial balance you found that a new additional bad debt is written off. So this is the real figure. From this 5% is considered as doubtful debt. Okay, so 5% of 49,120 into 5 divided by 100 will be 2000. It means new provision is 2456. Okay, but we already have a old provision here. See here 2300, so that old provision also should be taken, 2360. Okay, so this is new provision and old provision. See here, if your new provision is greater than old provision, okay, that is called as expenses. If your new provision is less than your old provision, then it will be written as a income. Okay, so here you can see the difference, 2456 minus 2360 will be 96. Here new provision is greater, okay, old provision is less compared to okay, this is the 5%. New provision means 5% of the available trade receivable. Okay, so the 96 will be treated as it is treated as provision for doubtful debt. Okay, so you can write here provision for doubtful debt. So always remember, the new provision is greater than old provision, it is an expense. Provision for doubtful debt, it means 2200 and what was the value, 2456, 2456 minus the old provision was 2360. Okay, how you got 2456? Reduce 150 from trade receivable and find 5%. So it means new provision minus old provision. Okay, then you will get 96. But if new provision is less than old provision, then it will be, you will write here, okay, in the other income column. Then always be careful about it, whether it is identify whether it is expenses or revenue. So here because here new provision is more, okay, it covered old provision also. Last year also you kept some percentage as doubtful debt, so that is just for a precaution. Okay, you are doubting that particular money will not come back, but this year also you are keeping. So if it is covering last year's amount, then it is revenue for you. Okay, if it is crossing the last year's balance, then it is additional expense. The 96 is additional expense you have to create as doubtful debt in your business this year. So the next part is depreciation we have to do. So doubtful debt is done. So fixtures and fittings to be depreciated, it is using straight line method. So in straight line method you don't need to consider old provision of depreciation, because here you can see provision for depreciation on fixtures and fittings. This is old provision, okay, provision for depreciation. But if it is straight line method, directly you can take it from the cost price. Here cost price of the fixtures and fittings at cost is 35,000. Provision is also given. Okay, if it is straight line method, no need to consider older provision. So you can consider directly from that how much it is, 20%. So it will be like 20% of 35,000. Okay, so right here as a expense, depreciation fixtures and fittings. Okay, fixtures and fittings, it means it's using straight line method, so it is 35,000 into 20%, right? 35,000 into 20%, so you will get 7,000 something, 7,000. Next is depreciation using reducing balance method. So this is done. Motor vehicle are depreciated 25% using reducing balance method. If it is reducing balance method, till now how much depreciation we calculate? The provision for depreciation should be deducted. Okay, if it is reducing balance method. So provision for depreciation of motor vehicle is 10,500. Then cost motor vehicle at cost is 24,000. So 24,000 minus 10,500. Then find the percentage. How much percentage? 25%. So the calculation will be depreciation on motor vehicle. It will be here. Take the cost price first. Motor vehicle is 24,000, isn't it? Less the older provision 10,500. Then 25% of that. That will be your depreciation of motor vehicle 3375, isn't it? Now we took all the items. I guess we took all the items. Here you can see the adjustments. We took all the items. Now consider the total expenses here, or calculate the total expenses: 10,480, 41,000, 5,335, 150, 96, 7,000 and 3,375. The total will be 67,436. Now apply the rule or equation: gross profit plus other income minus other expenses. It will be profit of the year will be 52,104. It will be profit of the year. Okay, profit for the year will be 52,104. So this is the calculation of Preeti's financial statement. The statement of financial position I will do in separate video. Okay, it will be continuation of this. So the profit of the year calculation will be like this. So always remember the formulas. Gross profit is revenue minus cost of sales. Cost of sales is opening inventory plus net purchases minus closing inventory. Net purchases will be purchase minus purchase return plus carriage inwards minus goods for on use. And net profit calculation will be gross profit plus other income minus other expenses. Consider this adjustment also. These all are the adjustment. Okay, these are very important for income statement. If it is accrued expenses, it is added. If it is accrued income, also added. All accrued will be added, or prepaid will be deducted. Okay, in SOP we will consider that. I will explain in that video. Okay, thank you.